Hello everyone, I'm Mr. Mortgage, and today I'll be your guide to understanding the world of mortgages in the UAE. It's essential to have a clear understanding of the different types of mortgages and transactions when navigating the housing market. So let's dive in and explore the intricacies of mortgages. Let's begin by taking a closer look at the two main types of mortgages available in the UAE. 1. Conventional mortgages. Conventional mortgages are the traditional mortgages offered by banks and financial institutions. They follow the standard structure that you're probably familiar with. With a conventional mortgage, you borrow money from a lender to purchase a property, and you repay the loan over a fixed period of time with interest. These mortgages usually have a specific down payment requirement and are subject to the lender's terms and conditions. 2. Islamic mortgages. An Islamic mortgage, also known as a Sharia-compliant mortgage, is structured to comply with Islamic law, ensuring that they are interest-free and aligned with ethical and religious principles. They provide an alternative option for individuals seeking home financing while adhering to Islamic requirements. Now let's delve into the different types of transactions you may encounter in the mortgage landscape. 1. Primary sale last payment finance. This transaction involves financing the purchase of a property directly from a developer. It's commonly used when buying a brand new property from the developer. 2. Resale buyout. In a resale transaction, you're purchasing a property from an existing owner. This is a common scenario when buying a pre-owned property. A resale buyout refers to the process of buying out the existing mortgage on the property from the seller. 3. Buyout, switch. The buyout or switch transaction occurs when you want to switch your existing mortgage from one bank or financial institution to another. There are various reasons why someone might consider this option. It could be to take advantage of better interest rates, reduce monthly payments, or avail of additional features or benefits offered by another lender. 4. Refinance, cash out, or loan against property. Refinancing allows you to modify your existing mortgage by either obtaining better terms or releasing equity from your property. Cash out or loan against property refers to the process of refinancing your mortgage to access additional funds based on the value of your property. This option is often used when you need extra money for purposes such as home renovations or buying another property using the equity on your current fully paid-up property. 5. Only rental income. In some cases, rental income is the primary source for mortgage eligibility. This can be an option for those who have rental properties and want to leverage that income for a mortgage. 6. Non-resident cases. Non-resident cases refer to individuals who are not residents in the UAE but are interested in obtaining a mortgage. 7. Low docs cases. Low docs cases involve individuals who have limited documentation as self-employed individuals. In such cases, the lender may have specific requirements to assess the borrower's creditworthiness and repayment capacity. 8. Commercial mortgages. Commercial mortgages are specifically designed for individuals or businesses seeking financing to purchase commercial properties, such as offices, retail spaces, warehouses, or other properties used for business purposes. 9. Offset mortgages. Offset mortgages allow you to link your savings or current account with your mortgage, reducing the amount of interest you pay by offsetting your savings against your mortgage balance. Now, let's shift our focus to the documents required for mortgage applications. For salaried individuals, the bank requires copies of your passport, Emirates ID, visa, and 6 months of bank statements. It's important to note that if there is variance in salary, or if you receive commissions or additional allowances, the bank may also require 6 months of payslips. These payslips provide a comprehensive view of your income and help the lender assess your repayment capacity. Similarly, for self-employed individuals, the required documents include the trade license, share certificate, memorandum of association, MOA, with all amendments, articles of association, AOA, if applicable, company profile, 6 months of business and personal bank statements, and 2 years of audited financials. Now that we've covered the different types of mortgages, lending scenarios, and documentation, let's walk through the general process flow of a resale transaction. 1. Pre-approval. The first step is for you to obtain pre-approval from the bank. This involves submitting your financial documents, such as bank statements, income proof, and other required documentation, to the lender. The bank evaluates your eligibility and financial capacity to determine your budget for purchasing a property. 2. Client finalizes property and signs. Once you've been pre-approved, you proceed to finalize the property you wish to purchase. You sign a Memorandum of Understanding, MOU, with the seller, which outlines the terms and conditions of the property sale. 3. Valuation. After finalizing the property, the bank requests a property valuation. A professional valuator assesses the property's market worth to ensure that the purchase price aligns with its value. This valuation is essential for both you and the lender to determine a fair price for the property. 4. Current account opening. If you don't already have an account with the bank from which you're taking the mortgage, you'll need to open a current account for mortgage repayment. 5. Final offer letter. Based on the property valuation and your financial profile, the bank issues a final offer letter. This letter includes the terms and conditions of the mortgage offer, such as the loan amount, interest rate, repayment duration, and any other pertinent details. You carefully review the offer letter and sign it to accept the terms. 6. Disbursement of the mortgage. Once the offer letter is signed, the bank proceeds with the disbursement of the mortgage. 7. Mortgage registration and transfer of property at DLD. After the mortgage disbursement, you and the seller proceed with the registration and transfer of the property at the Dubai Land Department, DLD. This involves completing the necessary paperwork and paying any applicable fees. Once the transfer is completed, the property ownership is officially transferred to you, and the mortgage is registered against the property. It's important to note that the specific steps and requirements may vary, depending on the jurisdiction and the policies of the bank and relevant authorities involved in the transaction. I hope this information helps you gain a better understanding of mortgages in the UAE. Remember, it's always a good idea to consult with a professional or a mortgage advisor to get personalized advice based on your specific situation. Good luck with your education video.